All right, so that concludes our day three, future today, tomorrow, right? So how we can bring the technologies of the future to today. And I personally, the first conversation was near and dear to my heart because, as I said, I was doing with the probability of default and the modeling different consumer loans for a number of years, working at Goldman Sachs, also starting their retail business, Marcus.com, and working the models there. So some of the things that our first speaker has mentioned was near and dear to my heart. I also know that there have been several questions that I want to see. So for the predicting of example payment defaulting, how do you see the potential of FinTech influencing external policy that has a tendency of reinforcing decision to the negative? And then let me probably answer this, and if I got the question exactly. So I think that in general, in those models could be either risk averse or risk taking, right? So pretty much your model gets some point, and your question is that do you actually want to give credit to this person or not, right? So pretty much the model is really agnostic in terms of what you do with that score, right? So for example, if some companies will give only credit if the model produces a score above 50, right? So there's a possibility of more than 50% that this person is going to return. Nevertheless, and we see it over and over, cycle and cycle again, as soon as the economy becomes better, people are actually relaxing those rules and giving out credit, even though their model is saying it's still riskier than, let's say, a traditional model would allow, let's say, 2 years ago. So that's one of the things that I think is important to understand, is that all of those models, all of that AI is not necessarily providing a solution to whether we should give credit or not. It is still people who make this decision based on the model. So did I answer your question?
Yes, indeed. Yes, indeed. Thanks. You did.
Awesome. Awesome. And then, yeah. So, and then in terms of regarding fraud, right? So identity related fraud is actually really interesting, and it is right now, it is actually proper in B2B. So for example, there are companies like Comply Advantage, such as Squid, that actually do this, right? So they provide the AML, anti-money laundering, and KYC and KYB functions to their customers, and therefore they kind of know what is the particular customer is, and they do actually protect sort of only on the business side about the identity fraud, right? So for example, if let's say you can see that the same person doing transactions, they can actually share across different financial institutions who are customer of Comply Advantage because they have the centralized storage of the activity. Then in terms of the fraud that happens on the B2C side, it's a little bit more time consuming. It's actually a bit more protected, usually in the majority of the jurisdictions, than B2B compliance. But then at the same time, there is a lot of flagging that is done to credit agencies. There is a lot of flagging that is done to different other agencies. It still takes longer, but nevertheless, it could be done, and it is being done, just with a little bit slower procession. Then there was also a question about since deep learning has that much prediction accuracy but lacks interpretability, is there anything research-wise being done to try and improve interpretability? I think that yes and no at the same time. So for example, you can, when you build the, let's say, logistics model, so that you can actually look and see how they actually are, you can actually visualize them, and you have like a slider, so they can provide you, if my loan to value ratio increases, how it's being done, right? So that's easy to interpret. But then on the other side, I think as of now, it's my favorite question to all of my data modelers who work for me, is that once they deliver the model, be it the trading model, be it a credit model, is that okay, so what, right? So what does it mean? What business value does it bring? So I think as of now, it is mainly on the purpose of a particular person, of how to interpret that data, interpret that model. There are some developments where you don't need to know like Python, you don't need to know SQL, you don't need to know R to do that. You can actually build it kind of as a constructor and see what model gives you. But then at the same time, it's still up to interpretation, and still even the most sophisticated the most sophisticated ML is still, it is in the very few cases it actually makes decisions, unless like trading algorithm. It's actually in the majority of the times, it is actually provides as an additional pillar for making a decision. Yeah, so that's hopefully I answered your question on that one. Do you have any other questions amongst the first or maybe second points? Yeah.
No thanks.
All right. So I also I just wanted to quickly share about my my personal experience about today. Again, the first session I knew pretty much the majority of the things that was said, but it was still very interesting to hear kind of the other take on this. And then the second one was really interesting to me to see how we are becoming more and more personalized and more geared towards that personal experience. And I think it really works well with the banking, with the open banking concept that we talked about, right? How both the first speaker can pretty much, we can do more if we have more data, but then also the second one, how we said that if we can actually open some of this data, might not even necessarily financial data, but the behavioral data, the purchase data, right? How we can actually provide the better services. And I also have this idea in mind that one day, and maybe it's going to be my startup of the dream. There's people are going to pay for the advertisement. So now companies are paying to advertise to you, but then I think in the future people will be paying to only show the advertisement that is relevant to them, and that is relevant, that will be much more directed, and people will be willing to pay to get a certain content delivered to them that is tailored to their needs and tailored to their responses, instead of being bombarded by this mostly irrelevant information. So that's kind of my take on it. Anyone wants to share about the today's session?
Hi, it's me you're calling.
Hi.
Yeah.
Yeah.
This is a very interesting day. For the first part, comparing the fintech of traditional bank, is very good to understand what is the focus of the fintechs, what it tries to bring value, and how it increases the experience for the client. If you have better prices, more credit, and things like that. It's good to know the reasons. One point that is not so clear to me, it's about the machine learning regarding the banking transactions, because this, I think that it's a mix of the open banking classes that we have yesterday. How can the institution get more and more information about the individual to give the credits only with his own transactions, or if the institution gets other banks' transactions to let know what's happened, because I can give a lend here, but the clients if a problem in another bank. So that's it's quite difficult to me to see the interaction between the machine learn and the needs of the open bank.
And that's actually that's a really great point, that pretty much the quality of the machine learning will depend on the data, right? And it's like this cliche term, garbage in, garbage out. And that's why companies like Comply Advantage and all of this, they can extract that back office, middle office transactions, right? They can actually unite the data from the different banks and provide a better understanding of what is happening. But then at the same time, a lot of cases, especially in the credit card transactions, and I'm just going to give you like example because I think it's a little bit easier to understand, is that in the credit card transactions, they do a time series analysis where they say, okay, if you, let's say if I am Vlas, Lezin, right, and I live in Salt Lake City in particular, right? So if I live, let's say in Salt Lake City or San Francisco, wherever I might be, right, I might actually, this is where I shop. And then suddenly, right, while I just did a transaction in Silicon Valley, and 2 minutes later I do a transaction in North Carolina, that's something that goes out of the pattern, right? And the same goes to the AML, same goes to the others, that I can actually, from the pattern of how I pay, what I pay, when I pay, I can actually derive what kind of behavior I have, right? And for example, in a lot of mortgage solutions, that when you give access to that open banking, when you give access to your account, they might not actually look at the transactions per se, but they might look at the balances, right? So let's say if they can see that every month you have a stable balance of what goes in and what goes out and kind of stays the same, that means that whatever you spend is whatever you get. So that can actually provide value a lot. So yes, there is a lot of issues with the fragmented data, but there are several solutions that could be done with this fragmented data, as well as there are companies who are trying to take this fragmented data, such as Plate, such as Complay Advantage, put them together as Credit Karma, to put them together and extract value from the different accounts in the different banks and the different institutions. And that goes both for the B2B and B2C.
And for the omni-channel, it's very interesting because it's really improving the client experience. If you do something online and you go to the store needs to be able to recognize that you are in, and then try to synchronize your interest in what you want to do. Exactly. So it's very, very good to know. And it's good to know that investment firms also could create value from this kind of service, using this as a service to map clients, to get more information about even high net worth clients that are so different, so special.
Yeah, and it's actually, I think what is also interesting about this whole concept is that, and general machine learning, right, is that maybe for one particular person, that model will not be right? So for example, if I go in and like I'm Vlas Lezin walking into, I don't know, some brokerage, right? That model might not be correct, but statistically speaking, we'll probably, for the like 85% of the cases, we will get a better match than we just try to do it from the thin air. So I think it's really important to understand that all of the machine learning models, the omni-channel, trying to predicting, any kind of predicting does not need to be right all the time. It just needs to be right in the majority of the times.
Thank you.
Absolutely. Anyone else wants to share?
Yeah, I always find machine learning applications quite fascinating, and I also appreciate the omni-channel experience presentation, something quite fascinating as well. And looking at this, honestly, if people who build business models around this, is something that is worth exploring. Now, but back to machine learning, I think Nitesh mentioned the fact that your model would obviously improve over time. The prediction accuracy may not be great initially, but over time it would improve as you get more and more data. Are we looking at a case where the training of the model is happening on the fly as we get more and more new data? Or are we getting to a point whereby we are saying at some point we will then probably retrain the model offline and then put it back in?
Yeah. So that's actually a great question. And the answer is both. So for example, for a lot of machine learning algorithm that is used in advertisements, such as Facebook and all this, those are actually what is called reinforced learning. So there's like three types of learning: supervised, unsupervised, and reinforced learning. And those and there are some applications in trading as well for the reinforced models, but pretty much they train as they go, right? So for example, if we're talking about advertisement, they start with some educated guess, so to speak, and then they refine to see, they try different cohorts, different population to whom show those advertisements, and they learn as they go who will open most. So for example, you know, they have like 3 groups, and they have 3 subgroups in one group, and they see which of those subgroups opens more. So the next time it will increase the show of this advertisement to the subgroups that are clicking more on that first try, first experiment that they had. So that is being used, and it's also used in the network models for high-speed trading and just for the quantitative investing in general. But as we go to the credit, as we go to those models that are predicting the underwriting policies, in the majority of the countries, those are very strictly regulated, making sure that they're not discriminatory, making sure that they are being fairly and accurately done and being checked. So usually what happens is that big institutions, they would usually review those models quarterly, be it student loans, be it consumer loans, be it the credit card loans, mortgage loans. They usually review them quarterly. And they first, how they do, right? So they buy the data, right? They build their initial model, and then they run it. And then in the quarter, every quarter, they go and they review whether their model is correct. There's also a lot of segmentation. There's a lot of ways how you can actually test it, fitness of curves and all those wonderful things. And they refine the models and they refine coefficients and refine the overall output every quarter, because it is mandated by the regulators. And they cannot be like fully reinforced, so they cannot make those decisions on the fly, because under the current regulations, those are harder to defend, and those are the majority of the regulators, like I do not know any kind of national regulator that would allow to actually this reinforced learning in the consumer finance. So those models are being looked at, and those models are being modified, but they modified on a quarterly basis by people.
So in the reinforcement type, you would have continuous streams of input data flowing in.
Yeah, exactly.
Okay.
So one example is that in the option trading related to the stock market trading, there are actual models that look at your put and call balance. So for example, in the very simple terms, right? If you look, let's say, if we're looking at the Delta stock with the expiration date on, let's say, January 20th, right? For example, January 15th, 2021, right? So by looking at the balance between put and call, so for example, if you have more puts than you have calls, that means that the market expects it to actually go down, and therefore you can short your actual stock, right? And those models are actually being used in trading, because those are not discriminatory. Those are not, looking at the sort of like people facing, they based on the behavior. It's kind of the same concept as implied volatility in the options trading, right? That you extract that value from the market, what the current bid and ask are. So but you can also extract your put call parity, and based on that, you can actually predict where the market is going to go based on the market incentive.
Right, thank you.
Yeah. All right. Any other questions, concerns, regrets, maybe?
Hello.
Hello.
Just maybe not a technical question, but just an inquiry to say, suppose we're looking for partners to collaborate with on such similar projects. What would be your advice? Considering that probably we may not have much of the experience on working with real-time projects, but would want to grow and actually be able to work with real-time projects with the partners that have experience in this kind of area. What would be your advice to us?
I think that would be better if we can connect offline and just kind of go over your needs and your requirements and your general stand, and then we can go from there.
Okay, thank you.
Yeah. I will make sure that we follow up maybe like by the end of the program. So there's going to be, actually, I'm going to cover some of those collaborations later on. But then I would love to connect to you and share my experiences and share my expertise, if you will, on doing such projects with the educational institutions.
Okay, thank you.
Thanks so much. All right, well, if this is it, thank you so much for the third day. Thank you for participation. Thank you for your questions, and I'll see you on Tuesday. Thank you so much.
Thank you. Bye.
Bye.